Right now, a wave of tax changes just kicked in across Australia. We're talking about shifts to income tax rates, superannuation rules, how HECS debt gets repaid, a brand new $1,000 deduction, and a bunch more. Some of these changes will put money back in your pocket. Others could take more out. And the difference between winning and losing here comes down to whether you actually know what changed and how to respond. So let's break all of it down, one change at a time, starting with the one that affects every single taxpayer in the country. From the 1st of July 2026, the tax rate on income between $18,201 and $45,000 has dropped from 16% to 15%. And if you earn $45,000 or more, that translates to a saving of up to $268 per year. Now, $268 might not sound life-changing on its own, but here's the thing. This is just the first step. From the 1st of July 2027, that same bracket drops again to 14%, which doubles the saving to $536 a year compared to what you were paying back in 2024 to 25. The government has essentially legislated 5 rounds of tax cuts, and we're now entering round 4. When you stack all 5 together, a worker on average earnings around $81,000 is looking at nearly $2,500 in annual tax relief by next year. Now, on top of the rate cut, the government has introduced something brand new, a $1,000 instant tax deduction for work-related expenses. This one is huge for simplicity. If you're someone who normally claims less than $1,000 in work-related deductions, you can now just claim the full $1,000 without keeping a single receipt. You just tick the box when you lodge, and your taxable income drops by $1,000. The government estimates this will benefit 6.2 million workers and deliver an average saving of $205. But here's what you need to understand. If your actual work-related expenses are higher than $1,000, you can still claim the real amount instead. You just need to keep your receipts the way you always have. So this doesn't replace the old system. It sits alongside it as a simpler option for people who don't have big claims. And you can also still claim union fees, income protection insurance, and investment expenses on top of the $1,000. Let's move to superannuation because this is where a major structural change just landed. From the 1st of July 2026, employers are now required to pay your super at the same time as your wages. This is called Payday Super, and it replaces the old system where employers could pay super once per quarter. Under the previous rules, your super could legally sit unpaid for up to 3 months, and billions of dollars in super were going unpaid every single year. That's money that should have been growing in your retirement fund but wasn't even getting there. Under the new rules, contributions have to reach your fund within 7 business days of payday. So if you get paid fortnightly, your super lands fortnightly too. This means your money starts compounding sooner, which adds up to a meaningful difference over a 30 or 40-year career. The super guarantee rate also stays at 12% for the 2026 to 27 year. And importantly, the concessional contributions cap has gone up from $30,000 to $32,500. That means if you're salary sacrificing into super or making personal deductible contributions, you've now got an extra $2,500 of room each year to build your retirement savings in a tax-effective way. And the non-concessional cap has increased to $130,000, up from $120,000. If you've been building up savings outside of super and you want to make a lump sum after-tax contribution, that extra $10,000 of headroom gives you more flexibility to do it. Now let's talk about HECS and HELP debt, because there's been a genuine improvement here. From the 2025 to 26 income year, the old system of flat percentage repayment rates was replaced with a marginal repayment model. Under the old system, crossing a threshold by even $1 could jump your entire repayment obligation by thousands. It was punishing. Now, you only pay the higher rate on the income above each threshold, the same way income tax works. The minimum repayment threshold sits at $67,000 for 2025 to 26 and has moved to $69,528 for 2026 to 27. If you earn below that, you don't make compulsory repayments. If you earn above it, you pay 15 cents for every dollar over that threshold, scaling up through higher brackets. This is a much fairer structure, and if you've got HECS debt, it's worth understanding exactly where you sit. On top of that, the government passed a 20% reduction to all existing student loan balances as of the 1st of June 2025. So if you had a $30,000 help debt, it was automatically reduced to $24,000. That change has already been processed by the ATO, but it's worth mentioning because a lot of people still don't realize it happened. Now, let's get into the Medicare levy surcharge thresholds. From the 1st of July 2026, the income threshold for singles has gone up to $105,000, and for families, it's now $210,000. What this means in practical terms is that if you earn just above the old threshold and you don't have private hospital cover, you might now fall under the new threshold and avoid the surcharge altogether. The surcharge itself ranges from 1 to 1.5% of your income depending on how much you earn, so dodging it can save you well over $1,000 a year. If you've been on the fence about private health insurance, this threshold change is worth factoring into your decision. The minimum wage has also gone up. From the 1st of July 2026, minimum and award wages have increased by 4.75%. The national minimum wage is now $26.44 per hour, or $1,004.90 per week before tax. For the lowest paid workers on entry-level rates, the increase is actually closer to 5.97%. This affects around 2.8 million Australians, and it's the largest dollar value increase to the minimum wage in recent memory. There are also a couple of changes that take effect from the 1st of July 2027, but were announced alongside this year's budget, and they're significant enough that you should start planning for them now. The first is negative gearing reform. From the 1st of July 2027, negative gearing on established investment properties purchased after budget night will be restricted. You'll still be able to deduct losses, but only against rental income, not against your wages or other income. If you buy a new build, the current rules still apply, and anything purchased before budget night is completely grandfathered. The second is capital gains tax reform. The existing 50% CGT discount is being replaced with a discount based on actual inflation, and a minimum 30% tax rate on capital gains is being introduced. These changes only apply to gains after the 1st of July 2027. And again, new build investors can choose between the old discount and the new system. These are the biggest structural reforms to property tax in decades. And if you're an investor or thinking about becoming one, this is the time to get proper advice. For small businesses, the $20,000 instant asset write-off has been made permanent. If you run a business with turnover under $10 million, you can immediately deduct any asset that costs less than $20,000. And the government has also reintroduced loss carryback. So if your business makes a loss this year, you can offset it against tax you paid in the previous 2 years and get a refund. There's a lot here, and the changes range from simple tax savings to major structural reforms that could reshape how Australians invest and retire. The bottom line is this: the people who take 20 minutes to understand these changes and adjust their strategy will come out ahead. And the people who ignore all of this will keep overpaying, keep missing deductions, and keep falling behind. So take what you've learned in this video and actually use it. Review your tax settings. Check your super contributions. Look at your HECS balance. Talk to a professional if you need to. If this helped you see things more clearly, do me a favor and hit the like button, subscribe to the channel, and turn on notifications